Hello and welcome to Commodity Champions. I'm Manisha Gupta. The metal prices are under pressure, setting off concerns of slow economic growth. Demand from China has fallen and investors await the stimulus to return. Meanwhile, the US dollar index is at a 7-week high, while uncertainty on US debt ceiling just about continues. And the US Fed's June meeting is being watched closely. Gold, on the other hand, has emerged as an outlier as its prices have fallen much lesser than other metals in the past month. The global banking crisis, the US debt ceiling, the massive layoffs have all provided further support to gold prices. And gold has once again proven to be a safe haven. To take this discussion forward on what really should you be including in your portfolio and where are the prices headed, we are now joined by Mr. Preetham Patnaik. He's head of commodities at Axis Securities, Ajay Kedia is director at Ajay Commodities, and Kunal Shah is head of commodities at Nirmal Bang. Gentlemen, hi, thank you so much for joining us here on CNBC-TV18 today. And I'll start with gold prices first, because even as the first quarter and even the month of April was quite strong, May clearly has been volatile. We've seen profit taking, and now the street is talking about levels of 1920 or thereabouts as well. Kunal, I'll start with you first. What's your sense on gold prices? There is just too much for the markets to watch out right now, but debt ceiling, if that goes through and the markets are anticipating that it will go through, then is there further decline coming in for gold?
Yeah, so first, like you rightly pointed out, there is a discussion regarding this debt ceiling. Nothing is moving on right now. There can be a volatility arising if there is a delay in lifting up this debt ceiling, and that can lead to some spike in gold. But right now, the narrative stands at gold is under consolidation. It requires a major trigger, and that trigger has to come from the weak US economic data or weakness in other parts of the world, like in Europe, we see a major weakness, something like that. So I see a very limited downside in gold from present levels. So 1950 to 1940 is a accumulating range for gold, and I continue to remain optimistic about the outlook of gold, even though it is corrected today or it may correct going forward. But going forward, the monetary tightening, the quantitative tightening may lead to a slowdown in US, and that will eventually lead to higher prices of gold. So this kind of downside should be used as a buying opportunity for gold. 59,500, 59,400 remains good levels to rebuild your long positions. And again, you can see gold during the second half testing levels of 61,000, 61,500 conservatively. So use this as a buying opportunity, this kind of fall, and build your positions, and you will be rewarded going forward during the second half of the year.
All right. Well, yes, most of the bets really are for the second half of this year now, because the one quarter is done. The second quarter at best is uneven, even more volatile, and major economic numbers also coming in for this quarter here. But the second half is something that most people are putting their bets on for various commodities. But we'll stick to gold for now. Preetham, what is your sense? As Kunal says, 1950, 1940 could be a strong support. Would you go with that?
I agree with Kunal to that perspective. I think 1950 on the spot prices is a very strong support for gold. But let me tell you one thing, Manisha. I think the only thing that the US, government and parties can agree on disagree. While all of them keep saying that they're moving ahead with discussions, but they're all sticking to their own agenda. So I think this is going to go to the wire. I don't see this happening immediately because I think both of them are not agreeing to the requirements that they've put in front of each other. So I think there it's going to go to the wire, and that means that there's going to be a huge amount of volatility happening. And during this period, unfortunately, the risk premium has not flown towards gold; it's gone towards the dollar. So once the news comes across, I think the dollar could weaken a little bit, and that could help a little bit support for the gold prices. But I'm more worried about the statements made by the Fed committee members, because two of them came across yesterday, and we thought that increase in interest rates was a done thing. Okay, we had discounted that completely. We talked about when will they start cutting interest rates. But yesterday they again kind of opened a can of worms and said that, you know what, I think there is still some headroom for doing some more rate hikes. I don't know whether those statements should be taken very seriously, because if that was the case, the Fed chair wouldn't have said that for the month of next coming, Fed meet, there would be no rate hikes. But nonetheless, it leaves the cat amongst the chickens, as they say, and there's going to be a little bit of panic, and people are going to be cautious about it. So my sense is, in rupee terms, 59,500 is a very strong support. If that is breached, we could see levels of 59,000, and from there we would pretty much kind of continue to go on with the long-term opinion of gold being bullish, and we would buy at that level. If 59,500 is retained, I won't be surprised to see gold bouncing back towards 60,000.
Okay, so the idea until now is to accumulate, buy on dips, and there are no short strategies. There's just too much uncertainty into the international markets right now to not hold the safe haven gold here. Ajay, how are you looking at the prices right now? As Preetham said, that the June rate hike or a June pause is what the markets were working with right now. Now there is a 20 to 30% chance that there could be a rate hike. And the other thing really is about the dollar index, where most market participants felt that we could go to 100 and reach that level as well. Instead of that, we are holding quite successfully above 103 for the last 1 week now.
Good afternoon. Surely, if you see whatever the fundamental we have talked about, the interest rate has already been discounted. It's a matter of 0.25, maybe or may not be depending upon the data point and all, like a recession fear are going on. But I think 0.25 rate hike has already been discounted. We have already seen gold prices testing 2080 level, and now it is retracing and taking a base near to 1950 level. So I hope market has already been discounted, whatever the big stories are going on. But still the environment, what we have seen since last 1.5 years, or let's say only in last 6 months, things have been going very well for gold. So I think this is just a pullback, but overall second half is going to be very much positive because still the numbers are not so much supportive, and recession fear or slowdown fears are continuously there in the economy. And in part of the inflation, never we have seen in last 10, 12, 15, 20 years, inflation immediately comes down. So it will take time. So I think 0.25 is a hardly a risk because of this only we have seen a pullback towards 1950 from 2080 level. So maybe a consolidation zone between 1936 to 1950 could be possible this week only. But from as we enter in the June month, we can see some good buying, particularly from India and China. Physical demand is now expected to again show some sign of strength. Whereas in case of dollar index, it is just a retracement from 101 level to, let's say, it can go up to 103.50 or 104 level, but it won't be sustaining looking to the data point and all other factors. So we are more bullish on gold and silver right now. Ratio is being slightly improved, but we can see gold heading towards, let's say, again 2130, 2150 by Q3 end, whereas on lower side a base towards 1930, 1936 should be a greater level to buy. On domestic side, rupee again play a very important vital role because now it's very close to 80 to 80 level, but a breach of 83.20 will definitely trigger a fresh weakness in rupee, which can drag towards 83.50 or 84 nearby, which will again support domestic gold prices. So maximum downside we are expecting 59, 200 would be a very good level to buy. On higher side, maybe we can see Q3 or near to Diwali, we could easily test near to 64, 500 zone.
All right. So yes, while the support levels have continued to come down, but accumulation is the major point here. So 1950, 1930 could be the near support levels for the gold prices there. And Ajay, because you mentioned about silver as well, and you said that this is a good buying level here too. Silver hasn't done as well as gold. In the near term, it did well, but it has seen a very sharp decline as well. $26 per ounce has continued to be a stiff resistance. Where do you see supports and resistance levels now for the rest of this year?
If someone want to buy silver, just compare with the gold-silver ratio, or let's say silver-copper ratio. I do remember in 2011, silver was around 75,000, gold was around 30,000 only. Today, gold has doubled, but silver still lying near to 75, in fact, below 75 only. Even gold-silver ratio, which is near to 83, 84 zone, we expect, let's say, in next couple of years, it come down towards 72 or 68 level also. Then also silver will easily cross 1 lakh mark on domestic market. Coming on international side, we have multiple of times seen support coming near to $22, $23 mark. But on higher side, we expect this year we may see a level like 30, 32 zone. But overall, if someone is buying silver for, let's say, a couple of year, definitely we can go near to 40 level mark. That is again level what we have seen in 2011 was $50. So overall on domestic side, we are more bullish because of rupee factor. Consumption, imports are quite high. We have seen because the industrial demand is there. So maybe on downside, worst in case 68,500 or 69 on a day-to-day volatility we can see, but this is also a good level to buy and hold. On higher side, we can expect at least 90,000 by end of Q3 or near to Diwali. But this year we may see prices easily crossing 90,000 mark.
Kunal, what's your sense? 90,000, 1 lakh. What are you putting your bets on?
No, I will not be that bullish, but I'll explain my narrative. The narrative is that we have started the year with a major deficit in the silver market. So I think silver market started with a deficit of almost 225 million ounces. So this is quite huge as compared to the size of the market, almost 20%. This kind of deficit we have not seen in last 10 years. So we are starting the year with a major deficit. Now the problem going forward will be the slowdown in the demand. So what we are seeing in China, the Chinese silver premium has gone down recently. So all these phenomenon has led to correction in silver futures. The dollar index has strengthened. So I'm expecting conservatively 84 to 85 base case scenario in a full bullish trend in gold or silver going forward. So 69,000, 70,000, these are the levels where I would again recommend to restart accumulating for the second half of the year. The bullish trend is going to continue. The deficit at the end of the year will be relatively smaller as compared to the start of the year, but still the demand moderation, the slowdown in the industrial demand in some of the segment in silver can lead to some bit of slowdown, but I'm expecting 84, 85,000, $27, 26 and a half, $27 on CME looks very realistic target.
All right. Buying silver, but at dips, and 70,000 could go away in the very near term, and those would be accumulating levels, and 85,000, 90,000 as also what Ajay said is a possibility. In just very briefly, what is your sense, Preetham? What range are you looking at?
See, I'm going to look at it very closely right now. I'm saying that if 71,000 is taken off, then you could see levels of 70,000, and I would be a buyer at that level.
Okay.
My sense is that, I mean, what two of my co-panelists have also mentioned, I think inherently there is bullishness in these base precious metals. Okay, there's no taking that away, right? So 70,000 could be a decent level to go into it, and my sense is that first level to look forward to is 80,000 in the second half of the year, and if that is breached, I mean, I would love to take what Ajay said about 1 lakh, but I'll be conservatively optimistic and say 85,000 is what my levels are. That.
All right. All right. We'd love to have higher levels here, but yes, the market has been very volatile and we'll keep our cards close is what our panel is doing. But with that, we'll go for a very short break. We've spoken about gold and silver, but don't go anywhere because the discussion continues about metals when we return. Welcome back. You're watching Commodity Champions. Let's take a look at the metals now, where the last 4 or 5 weeks in continuation haven't given you positive returns. We've seen metal prices trade quite volatile. The individual fundamentals are not working. The China's data has been on the weaker side. There is a slowdown here. The COVID cases in China seem to be increasing. And the markets have been for long waiting for some solid, concrete Chinese stimulus to come in, which also is in absenteeism. Kunal, what is your sense? If you look at copper, aluminum, zinc, these kind of metals, we've seen markets move too fast on either side, and that is the reason that keeps the street edgy, because once the fundamentals start kicking in, we will perhaps see the prices rise too much. But at this point in time, that doesn't seem to be working.
Yeah, so quite rightly pointed out, the macroeconomic scenario in China continue to remain grim. We have seen all the data, and the data recently which came out, if I start seeing that numbers on a 2-year CAGR basis, the demand side is horrible when it comes to industrial production, when it comes to fixed asset investment. You take any number, it is pointing towards a major contraction, maybe 8%, 10% contraction. This kind of contraction is not seen even after the reopen of China. So this clearly indicates the property sector, which remains the backbone of the Chinese economy. So 25 to 28% of the total metal demand comes from this sector, and we have not seen any revival. After the weak data, there was an anticipation that Chinese government will come up with RRR cuts or perhaps stimulus packages. So neither of them came, and that's the key reason why metals are sliding the way it is. Until and unless we see some meaningful support by Chinese government, we are still going to see another 4 to 5% hit in most of these metals. And irrespective of, and another thing which has happened is that last year we had a European energy crisis. So most of the European smelters were out of the market. And right now they are producing metals at a robust pace. So the supply concerns have eased from Europe and the demand growth have cooled down from China. So supply is increasing and demand is contracting. How the metal prices are going to move up? So we need some concrete measures from China which will prevent this fall of prices. Otherwise, metals are going to go down on its merit. And remember, apart from all of these, I said there is a quantitative tightening going on. So it's a very deadly combination. I still don't see optimistic scenario for metals, and another 4 to 5% is my conservative targets for the downside.
All right. Ajay, what is your sense? Do you also think that whether it's copper, aluminum, zinc clearly trading at 2.5-year lows, the major decline clearly has come in for zinc, and that refuses to see opportunity buying even at these current levels. But what's your sense, as Kunal says, 4 to 5% further decline before you start buying?
Yeah, definitely. In last 1 month or itself, zinc has dropped around 12%, or since January we have almost seen 20% fall in zinc prices. Copper is still trading, but I think the concern what we are looking, similarly Chinese government is also looking, and since last 5 months they were trying to come up with a stimulus, or we can say any kind of support to the economy. So I think this is a slightly a panic situation, because levels has been significantly dropped. Like in LME, if we see, copper is around let's say 8,000, or zinc is around 23. In fact, there are many bankers that has came down with their projections. Like Goldman has lowered their aluminium copper outlook for 2023. They are expecting around 2850 at least for aluminium, and 10,000. Still, they are expecting 10,000 for copper. So I think second half is going to be very much important, because central banks are definitely pushing their whole efforts to bring back the economy on part. So I think initially up till mid of June, we may see some kind of weakness, because G7 has again came out with a fresh sanction triggered on that is again creating a pressure on base metal. It is a temporary, already prices has factored in. So maybe in next 15-20 days we can see some kind of weakness to be there. But I hope levels like 700 for copper is going to be a very good level to take us support, because economies anyhow is going to be on a positive side. Zinc already prices has corrected very well. Technically, it shows a support like 208 to 10 level. Aluminium, despite so much of fall in other metals, aluminium is showing since January it has only fallen by 0.5%. That clearly shows something has been getting supported. So I think a major downtrend has been already been there. Next 15 days, maybe another fall of, let's say, 4 to 5%, as Kunal has already told. But I think as we move beyond mid of June, prices should get a very good lift. Top pick could be aluminium and zinc as of now, and copper would take slightly more time. But overall, I am expecting Q3 is going to be positive for base metal.
All right. January actually has been the best month until now for this year when you look at metal prices. And from those kind of levels, we've seen a very sharp decline come in. Preetham, what's your sense? Any top metal trade that you see in this space? Or would you also say that it's the macros driving the whole sector and another 4 to 5% of a decline before you start accumulating?
Manisha, it's very difficult to see any positives right now as far as metal spaces goes. You know, the circus which is going out in the US markets, right? And the fact that, China has not kind of bounced back in the same proportion that we wanted. I mean, let's not discredit them. The numbers have come better, but they're not in line with the expectation, right? There's a huge amount of slowdown happening now. When obviously the bellwether of all good economic times is copper, and if you were to look at copper action which is happening, clearly there is an increase in production. Even in China itself, also you've seen production numbers going up. But in terms of demand, there's a little softening, and it doesn't help that globally also the demand is not picking up. So my sense is that broader base metals are going to find it a little tough for the next 1 or 2 months. My sense is till the time there is not any inorganic action by the central banks in the way of either a stimulus program being done or aggressive interest rate cuts coming into place, only those would be a trigger on which basis we should try to look at base metals. My sense is that, but everything has its own bottom. I hope I've not spoken too soon, but I think, let's say in copper, 700 looks like a very strong support level. Because I think after it reached 720, it's been falling and it continues to fall towards first level be 708. But after that, I think 700 level is very much reachable. And as far as zinc goes, 210 levels is again a decent level to start looking at the metal with some interest for buying. As far as aluminium, it's been moving in a range of 205 to 210. So on the lower range, we'll continue to trade on that range basis. If it comes around 205, we should look at entering that contract and exiting closer to 210. And that's how the three strategies is what I'm going to play out with.
Noted that. So, I mean, as you guys are saying that the third quarter is going to be better, 4 to 5% of a decline. The month of June should start picking up. The only concern here, Kunal, is that these metal prices move quite fast. We already are sitting on strong fundamentals. If there is a stimulus from China, if the Chinese demand recovery seems slightly better, if you see some supply concerns somewhere, then what is the reward ratio on the higher side that you will see building up immediately for metals?
I think it is copper. Copper on the long-term basis looks pretty bullish. Mainly, the emerging market demand for copper is going to revive. So, for example, India. So, I'm expecting Indian copper consumption can surge from almost right now it is roughly around 1.5 million tons. It can go up to 2.5 million tons in a matter of 3 years. So, a huge demand growth is expected out of India. So, there are some silver linings. And the EV demand, the copper is going to be the most preferred metals out of the entire base metal complex from the EV point of view. So the EV revolution expanding in next 2 years also going to, so whenever there is a U-turn or whenever there is a possibility of bounce back, I think copper is one metal where one should be fundamentally, one should go along because the demand from emerging market is just tremendous.
Oh, well, absolutely. And that's perhaps many of the global banks and brokerages also are foreseeing. That is the reason Citi and Bank of America and Goldman Sachs have talked about $10,000, $12,000, even $15,000 of price projection for copper. That, of course, is 4 or 5 years ahead. But 4 to 5% of a decline in metals, and those perhaps would be good accumulation levels. Gentlemen, thank you so much for joining us and talking the whole host of fundamentals that impact the metals as a sector there. But with that, it's a wrap on this edition of Commodity Champion. Thank you for watching.